Today's lecture, we're going to go over the effect of depreciation in investment and show you how to calculate operating cash flow. For investment, we often need to buy machines and equipment. These are the fixed assets tend to last a long time. Usually, the cash flow is paid at the time of the purchase. But accounting rules will require us to match expenses over the life of the assets. Depreciation itself is not cash outflow, so it is non-cash expenses. It is still deducted from taxable income. As a result, depreciation will affect tax payment. The more depreciation claim you have every single year, the more tax you're going to save. So we call this is Depreciation Tax Shield. To compute, simply use the annual depreciation expense multiplied by the tax rate. Suppose you are the manager. You really want to boost cash flows without affecting your sales revenue. Can you manipulate your depreciation schedule? Should you depreciate faster or slower? The answer is yes. If you depreciate faster, it's going to boost the cash flow temporarily. Commonly, there are two ways of depreciation: straight line and MACRS. Straight line depreciation is easy to understand. Every single year, the depreciation is the same constant rate. We use initial cost, subtract estimated salvage value, divide the number of the years. This one is not as popular as MACRS schedule. MACRS schedule, to do this, step 1, we're going to find out what is appropriate asset class table, 3-year, 5-year, or 7-year. Then we can use the percentage given in those table and to compute annual depreciation rate, depreciation expenses. Most time you will see there's one more year at the end of each asset class table. For 3-year, they tend to list the 4 years for the purpose of help the company to calculate mid-year convention numbers. This table show you that the common type assets belong to different type asset category. After-tax salvage value become relevant at the end of the project life. You tend to sell the assets, and it still has residual value. The issue is that commonly the salvage value you can get is not the one listed at book value. Suppose there's outdated copy machine. Company sold it and get $150. The book value listed is already 0. Question: can we keep all $150? This $150 salvage value differs from the book value. This implies the original depreciation schedule is incorrect. So there's a need to adjust tax payment. After-tax salvage value simply equal to the salvage value subtract tax adjustment. The tax adjustment is based on the difference between the salvage value and the book value. How do we find out book value? Every year, the asset depreciate. So the book value is the initial cost subtract cumulative depreciation at the time of the calculation. Let's look at one example. The equipment costs $100,000 and additional $10,000 to deliver and installed. So the total cost of the equipment is $110,000. This machine lasts for 6 years. At the end of year 6, it's going to be sold for $20,000. So this is our salvage value. Corporate tax is 40%. Let's figure out the annual depreciations, book value, and after-tax salvage value using both straight line and the MACRS approach. In the straight line, what is our annual depreciation? The machine cost is 110,000, and we straight line all the way till 0, and over 10 years. This gives us the annual depreciation of 11,000. So what is book value at the year of 6? Machine cost is 110,000. Every single year, we have the same 11,000 depreciation. So after 6 years, the book value is 44,000. How do we find out after-tax salvage value? The salvage value is 20,000. Let's do the tax adjustment. Tax 40%. Let's multiply the difference between the salvage value, 20,000, and the book value, 44,000. We got 29,600. Here's the answer for you to. Now, how about the company follow a 7-year MACRS schedule table? So, number 1, let's figure out annual depreciation at year 2. Go to the 7-year MACRS schedule table. We know the year 7, the annual depreciation is 8.93. So, depreciation is 110,000 times 8.93%. So, this gives us 26,939. What's book value at year 6? There are 2 ways to do this. Initial number is 110,000, and we take off 6 years. So we're going to add up from 1429 all the way till year 6. So the last one is 6892. Total sum of these. So this way we got the book value is 14,729. There's another way to think about this. After first 6 years, there are only 2 more years left. These are 8.93, 4.46. So the book value at year 6 is 110,000 times 8.93 plus 4.46. This also gives us the same number. Now let's do the ATSV in this case. The salvage value is same, 20,000. Tax is 40%. The book value is now changed to 14,729. So this time we are only able to keep 17,000 in 91.6. Here is the answer for the previous calculations. I would encourage you to practice for one more examples. So this is a 4-year project. We're going to follow the 5-year schedules. And I would like you to find out ATSV if they sell for 1,370,000. Now we're going to turn to how to find out the operating cash flow. So companies that operate, sell goods, collect monies, has sales revenue, and also operating costs. So how do we understand how much cash flow is generated from operation? There are 3 different ways to do this. Tax Shield, bottom up, top down. For Tax Shield, we break into 2 components. That part we have to pay tax, and the part we got Depreciation Tax Shield. For the bottom-up approach, we start from net income and add back depreciation. As net income is located at the bottom of income statement, so we name it a bottom-up approach. Net income can also be written as EBIT subtract tax payment. For a top-down approach, we start with sales revenue, subtract costs, and tax payment. Here I listed the detailed step to find out the net income and operating cash flow. So we start with sales revenue, subtract both operating costs and depreciation to arrive EBIT. Then we subtract income tax. If there's no interest payment, the tax is tax rate multiplied EBIT. After we arrive at net income, we add back depreciation to get operating cash flow. So this list, the table list of bottom-up approach is useful when you have very complicated sales numbers. That is, if your sales revenue change every single year, if your depreciation follows MACRS schedule, change every single year. Sometimes operating costs also change every single year. So if you use this table approach and calculate through use Excel template, it's going to save your time. I would like you to take a look at one example. Let's practice calculating operating cash flow. This company has an investment in new pretzel twister. The machine will cost $20,000. It's going to depreciate a straight line to 0 over 2 years. It's going to create additional sales revenue of $50,000 every single year. The expense is $35,000. So let's figure out operating cash flow. So first of all, let's figure out annual depreciation. For straight line, machine costs $20,000 all the way till 0 and over 2 years. So the annual depreciation is $10,000. Then we are ready to solve operating cash flow. I'm going to show you both tax shield and bottom up. The annual sales revenue is $50,000. Operating cost is $35,000. So this component we do have to pay tax, 40%. Annual depreciation we got is $10,000. So this will tell us the depreciation tax shield. After running these numbers, I got operating cash flow is $13,000. Let's practice bottom-up approach. To get EBIT, we start with sales revenue, subtract cost, subtract depreciations. EBIT, earning before interest before tax. So this amount is EBIT. And the tax is simply 40% of that. EBIT is $5,000. So tax is $5,000 times 0.4, we got $2,000. So now go back operating cash flow formula. EBIT is $5,000, tax is $2,000, depreciation is $10,000. We're going to get, again, same answer, $13,000. Right? So either approach, tax shield or bottom up, they should arrive the same answer. I listed how we use table approach to solve bottom up. Here is another practice for you. I'd like you to read this question, use either tax shield or bottom up approach to find out the answer. Remember, always compute annual depreciation first. Come back, check your answers. Did you get it? So that concludes our lecture on depreciations and operating cash flow.